Hello, hello, welcome back. So the Nasdaq has been completely annihilated this year. It's down about 30% actually year to date, which is absolutely insane. And a lot of tech companies, a lot of the high flyers have been completely annihilated. The S&P is down as well, the Dow is down as well, quite substantially. And so I wanted to take this opportunity because it is now when money is made. Remember, in the stock market, money is made when you buy, not when you sell. And so when the market is down a lot, you need to seize the opportunity. And you may not want to buy like everything, of course, like not spend all your money initially, but you can still allocate a little bit and still continue allocating as the market goes down. This is the way to do it, not when the market is flying. You want to be buying when the market is actually down a lot and everybody is in pain and they're telling you how bad stocks are. This is exactly when you want to be buying, which is sort of like now. And I wanted to make sort of like a series now in the next few days and talk about companies that we have discussed in the past and we have analyzed in the past. But since they have moved a lot, companies like Alibaba, Facebook, Tesla, Amazon, all of these companies, I'm going to be making new videos about them and I'm going to analyze their financials. And of course, we're going to go through our stock evaluation tool and examine what kind of price it makes sense to pay after they have been completely annihilated, as you'll see. Like for instance, Alibaba here, take a look at this chart. The 1 year chart tells you of a story of for a company that has been going down and down in terms of its stock price. Now, we have talked about Alibaba a lot in the past. You can see here in the stock news that news are still kind of thriving here. You know, you will see May 19, May 19, pretty much every day there's news about Alibaba. And the recent one that I'm having here, Alibaba stock price outlook, why Alibaba is a bargain, we have talked about that. Of course, Alibaba is facing multiple challenges. Yes, we do know. It's China, it's the coronavirus, there's a lot of things, supply chain. And still, Alibaba is a bargain, is what the article is telling us, because the company is highly profitable. But we do not just blindly believe in articles, right? We want to take a look at our tool here and actually evaluate the company. If you haven't seen this tool before, this is actually our pretty much exclusive tool for the channel, in which you can gain access if you become a Patreon. You can become a Patreon by visiting the links below the description if you're interested, and pretty much help the channel and also help yourselves, because this can give you a lot of information about all sorts of companies, pretty much all the companies in the US and many other countries really. It includes like Canada, UK, and many other markets. But in this one, we're going to be examining Alibaba. And so let's take a little bit of a closer look. Now, the P ratio of Alibaba is still quite expensive, 24.4. Not terribly expensive, but still quite expensive. We typically want it to be 20, near 20 or less. Now, this is a tech company, of course. It's going to be higher than normal. And so I'm okay with that. And also, I don't pay too much attention to the PE. I pay a lot more attention to the price to free cash flow, because free cash flow is what we care about, is the actual money that the company generates. Because profit can be different can be different than free cash flow because of multiple reasons really, and it's accounting reasons for the most part. But price to free cash flow 8.4 is absolutely great here. It's going down and down. Now, a little bit of a dilution going on, but the company has announced share buybacks, so this is gonna get better. So practically speaking, I think this is actually a green, because if I buy now, I'm actually getting the benefit of the buybacks, and these have been announced already. Now, 3.26 is the total liabilities to free cash flow for the last period, which means that the company would require about 3.2 years to pay back all their total liabilities, 3.2 years of last year's free cash flow, that is. And we will examine the finer details. But take a look at these numbers here, which I absolutely love, and this is why Alibaba is one of my core holdings, really. 375% in terms of revenue growth is insane. From 20 billion to 110 is absolutely insane growth, unimaginable, really. And the thing is, we are looking at very high numbers now, 110, so you cannot expect this kind of growth to continue. This will slow down regardless of the market conditions. There's no way the company will keep on growing at 300% in 5 years. It's just not going to be happening. If you are reaching 200 billion, 300 billion, they will have to slow down. It's inevitable. Unless we had like twice the amount of population, I guess, in the US or China, maybe they could keep on doing that, but eventually they will have to slow down. And 5-year net income growth, same story. Look at these numbers here, keep increasing. And other things that I love about the company, very, very extremely solvent. They have very little debt, as you will see, compared to their equity. And also, we examine that based on the total liabilities as well. Returns on equity, 6.8. Remember, they are not doing tricks like short tricks. I mean, they're not really tricks. They are like operations of utilizing a lot of debt in order to increase their return on equity. But this is likely to increase since they're having stock buybacks. Because remember, return on equity is basically net income divided by the total equity of the company. And so equity will go down if the company is doing share buybacks more than likely. And so you can have a return on equity that is going to be higher potentially. We'll see that. Now, net income margins are a little bit low here, but okay, it's better, of course, to have higher margins, but as long as the company is profitable and makes a ton of free cash flow, I'm okay with that. They may be a little bit suppressed eventually, we'll see. But let's examine the financial statements and see what the company is actually doing in terms of their net income first. What happened through the years. Now you will see here that the revenue was 23 billion back in 2017 and it grew to 109. This is insane growth, of course. It's unfathomable. It's really, really great growth. And the net income here, likewise, 6.3 billion to 23. That's, again, an insane increase in terms of net income. And people may be looking at a recent quarter where, like, for instance, net income goes down like let's say 5-6%, but forget that the company has actually been growing tremendously through the years. And the thing is, this growth is reflected in the balance sheet as well. And so even if a year of net income is not great, the company still increases its balance sheet and makes a ton of free cash flow. And this accumulates over the years because it generates retained earnings for the company. We have talked about this concept. Retained earnings is basically a permanent account that actually holds all the net income that the company has been generating, the PL pretty much, the profit and loss that the company has been generating through the years. And so it's extremely important because it increases and creates wealth for the company. And you will see it here, retained earnings 15 billion to 84 billion, meaning that the company through the years is making more and more net income, and this keeps getting added to the balance sheet, thus creating a much better balance sheet over the years. People forget that when they are taking a look at the earnings report, the recent earnings report. It's not the thing that matters. The latest earnings report is just a hype thing. It's just for people to talk about and be like, okay, the company went down like 5% in terms of revenue, went up 5% in terms of revenue. This is probably more than likely relevant, and it has to do with current market conditions. But a balance sheet that gets much better, and you have retained earnings of 15 billion to 84 billion, that's my cup of tea, and this is why I love this sort of companies. They keep generating income and free cash flow like crazy. And so here you will see that the assets of the company have been increasing superbly from 73 billion to 257 billion. It's almost like a joke that this company has sold off, really. 26 billion here, 27 to 93.6 in terms of liabilities, but the total equity 46 to 163. This is 4 times as much as they had back in 2017, which is absolutely insane. And the company is down like 50% or 60% or something of that sort. It's an insane bargain in my eyes. And again, I'm being extremely objective. I'm just seeing the numbers here. And you may be saying that the current market conditions for China and Baba are weird, and this is why this is happening. Yeah, I get you, but this is going to be temporary. There is no doubt about that. 6.3 to 23 is the net income that we examined. And the net cash provided by operating activities, 11.6 billion to 35. Again, a massive increase in terms of operating income. Investing activities that are getting increased for Alibaba as well. And you will see here that the company has been purchasing some investments for the most part here, quite a lot of them. And also, over here, you will see that the company has been getting a little bit of extra debt here, which I kind of like to see because the company didn't have a lot of debt, and I want them to utilize debt for leverage. Now, this has to be good management here, because you need to be utilizing debt in a way that actually provides you with more profit is very important. But I do like the company to be a little bit debt leveraged. I don't want them to have zero debt, because debt is a very useful tool for companies as long as it is well managed and as long as the company is making a ton of free cash flow. And 5.7 billion when the company is making 28 in terms of free cash flow, that's a drop in the ocean. So Look at this cash, 20 billion to 54 billion gets increased. This may actually go down in the next few quarters because of the stock buyback, and this you will see that maybe the company will have a little bit less assets, but that's normal, and we actually do want that as investors. And the free cash flow, 9 billion to 28, another insane increase here, threefold increase really. So the company has been increasing like crazy. Top and bottom line, balance sheet, cash flow, everything has been increasing tremendously, and people are dumping it. So you get the story. So let's take a look at the stock evaluation tool and decide to discover what kind of price to pay for the company right now, because a company could be doing great financially, but a stock is a different thing. We want to buy a company that is doing great and is also on discount. So let's examine whether that's the case with Alibaba here. Now, this revenue growth has been tremendous, of course. We cannot and should not use these numbers, of course. These are extremely positive here, and they will more than likely not happen in the next few years. I'm gonna go something like 8, 10, and 12 maybe. So that is much more limited revenue growth for the next 5 years, and so the company could easily do better, I think, overall for the next 5 years. But still, 8, 10, and 12, I think it's fair to have this kind of growth for our evaluation tool here. Now, the net income margins, you will see that the last year were slightly suppressed here at 21%, but overall the company has been doing about 23, 25. I will go a little bit less. I will go, let's just say 17 here, 17, 19, and 21. So suppressed net income margins here is what I'm gonna be using. And the free cash flow margin, again, the company has been doing 90, 100, and 110. Now, of course, over here you could also use 100 everywhere if you really wanted to, which means that basically net income converts to free cash flow at the same rate, is what happened maybe near this year or close to this year, about 100%. So you could use 100% if you wanted to. It doesn't make too much difference. It basically calculates the free cash flow based on the net income. And the annual return is 13%, is what I typically like to use in my videos, because you can typically make about 10% just by holding an ETF, an S&P 500 ETF. You will see that through the years they pay about 10% minus inflation. Okay, so let's hit calculate. And notice where we are over here, even with very suppressed projections here actually. These are conservative projections for sure, pretty conservative actually, especially the net income margins here that I used. They are very conservative based on compared to what the company has been doing. And also the free cash flow margin of 100%. I could even go 90%. I mean, even if I go 90%, this probably won't affect it too much, frankly. And if we hit calculate, yeah, you'll see that it barely affects it. It does affect it a little bit, of course, but because the current price is so cheap, we are still way below our even our low estimates here, which is 8% revenue growth. I'm actually curious what will happen if the company generates zero revenue growth. I just want to see that. So we are almost there. Even if the company doesn't grow at all, 0% in the next 5 years, then our low estimates is like $80 and we're sitting at 86. So even with zero growth here, which means that this zero practically speaking too, I mean they're not zero, they are 17 and 90, but they are not increasing through the years, is what I mean, because the revenue is not increasing, so it's basically the same every year. We are still getting our low estimate at 80. So yeah, you will see that this company is extremely cheap right now. And yeah, even though people may be scared about China and what is happening in politics and stuff, like what's going to happen? Do you think the company is going to go bankrupt in the next 3 or 4 years? It's practically impossible. And so when the slump dissipates, this company will definitely be a massive success. I'm pretty sure through the years. You just have to give it a little bit of time. This is extremely cheap right now, and this is why it's one of my core holdings. So this was what I wanted to talk about in regards to Alibaba. And next up, I'm likely gonna be visiting Facebook and other companies, of course, Microsoft, Amazon. As I mentioned, I'm gonna be making a full-blown series on the beaten down companies that are amazing, really. They are doing tremendously well in terms of financials, and we really want to see whether they are worth buying right now after the Nasdaq and pretty much the stock market going down tremendously this month. So thank you for watching this video. I hope you enjoyed this one. Please remember to leave a like and subscribe if you're not a subscriber already. A lot more videos coming your way this week about a lot of well-known companies. As I mentioned, I'm gonna be revisiting. So thanks for watching. See you soon, guys. Bye bye.